Whether you're joining us on video or podcast, welcome to Shelton Capital Management's Real Investment Insights, where we try to answer your questions on some of the most pressing topics related to markets and the economy. I'm client portfolio manager Jonathan Bernstein. With me today is portfolio manager for the risk managed ETF strategies, Kim Eskew. Welcome to today's episode, Fixed Income Markets in a Higher for Longer Environment. Investors continue to wrestle with a bond market that looks very different than it did just a few years ago. As inflation remains stubborn, interest rates stay elevated, and Kevin Warsh begins his tenure as chairman of the Federal Reserve. To help us unpack what that could look like in practice and why that matters to investors, we're joined by Kim Eskew, portfolio manager for our risk managed ETF strategies. Today, we'll discuss why the Fed may be reluctant to change rates anytime soon, what inflation expectations are signaling about the future, and why long-term bond yields could remain higher than many investors really anticipate. Let's do this in a Q&A format. I think that would make a lot of sense. And let me just ask you a few questions. I think the first one that's on everybody's mind, you think the Fed may keep rates unchanged for a while. What's driving that?
Yeah, I do, Jonathan. I think the main driver of that is, inflation is still not back to target. Even if growth slowed, the Fed would have a hard time justifying a rate cut while inflation expectations remain above 2%. And then you've got energy prices adding, fresh pressure there as well. Additionally, with Kevin Warsh taking lead at the Fed, we are in the camp that he will take more of a wait and see approach rather than making any quick pivot in policy, in our opinion. Policy works through long and variable lags through the economy, and we see the Fed actually preferring to let that just the existing restrictive policy keep working through, hold rates steady to avoid cutting too early or over tightening into a slowdown.
Right. So they're going to maintain that independence.
That's our expectation.
Awesome. You mentioned inflation. Even if it cools a bit, you still see the inflation expectation as a risk. Talk about that a little bit.
Yeah, inflation expectations, they really matter a lot because markets price bonds based on, not just today's inflation, but expectations of what they think inflation is going to be over time. So, right now the 10-year TIPS break-even rate is in the mid-twos, which suggests expected inflation remains above the Fed's target rate of 2%. And, if the expectations for inflation remain elevated, long-term yields could remain high even if current inflation data improves. That's especially important for longer duration bonds because they're more rate sensitive. Sticky inflation expectations can also limit how much investors get from a Fed cut. Shorter-term bonds might do fine in that environment with the Fed, if they eventually ease. But longer-term bonds are, they're going to be more tied to those inflation expectations.
That makes sense. You also mentioned talking about longer-term bond yields. They could stay higher than many expect. What's causing that, and what should bond investors be thinking about now in terms of longer term bonds versus shorter term bonds? Can you explain that a little bit?
It's more than just Fed policy. Inflation uncertainty, fiscal deficits, heavy treasury issuance, and the geopolitical risks that we're seeing all lead investors to, a higher term premium. And in addition, we've got supply and demand environment that's less supportive. The Fed is no longer a steady buyer of bonds through quantitative easing, and demand from some of the larger bond holders outside of the U.S. like China and Japan. I feel that that's becoming less reliable. Bond investors, the main thing that they need to be thinking about is they shouldn't just assume that rate cuts are going to mean automatic strong returns for bonds across the yield curve. It's a lot more dynamic than that. And I think that that's where they really ought to be thinking about the importance of active management through an environment like this. Flexibility is going to be key and important. actively managing duration, credit quality, sector exposures, and where they sit on the yield curve.
That makes a lot of sense. So to summarize, while the Federal Reserve may remain on hold, at least in the near term, inflation expectations, fiscal pressures, shifting market dynamics, that could all continue to put upward pressure on long-term interest rates in an environment where maybe opportunities and risks can vary significantly across the sectors and the maturities. Active fixed income management may play an increasingly important role in really helping investors navigate that uncertainty. If you want to learn more or receive a copy of the article that accompanies this video or podcast, however you're watching it, email us at info@sheltoncap.com, contact your financial advisor, or give us a call at 800-955-9988. And as always, thanks for being part of the Shelton community, and thank you for listening.
Thanks, Jonathan.